AI is scaling at a historic, unprecedented speed. At the exact same time, crypto remains one of the most violently volatile asset classes on Earth. In 2024 and 2025, we traded the hype. We saw every token with AI in its name pump thousands of percent, only to crash a week later. But now, in 2026, the hype is settling, and we are finally seeing the infrastructure being built. Which brings us to the trillion-dollar question. Is the intersection of AI and crypto actually the backbone for a new machine economy, or is AI crypto just another buzzword cycle designed by insiders to pump useless tokens? Today, we're cutting through the garbage. We're looking strictly at the base layers, the stablecoins, and the harsh realities of token economics. Let's get into it. If you strip away the hype and the moon boy narratives, you realize something very quickly. Artificial intelligence actually needs blockchain technology. Not to be trendy, but to solve three massive functional problems that threaten to bottleneck the entire industry. Problem number one is the black box. Right now, centralized AI is exactly that. It is a completely closed system. We do not know exactly what data these massive models are trained on, which leads to unpredictable model bias, deepfakes, and billion-dollar copyright disputes. Content creators and publishers are constantly fighting over intellectual property because there is no clear record of where the AI got its information. Blockchain fixes this by offering verifiable data trails and immutable records. It gives artificial intelligence a transparent, unchangeable memory. If a piece of data is logged on a blockchain, you can cryptographically prove its origin, ensuring that the AI is learning from trusted, authentic sources and compensating the original creators. Problem number two is the compute shortage. The demand for artificial intelligence is vastly outpacing the supply of graphics processing units. Right now, centralized giants like the big tech monopolies hold almost all the compute power. Training a state-of-the-art model costs hundreds of millions of dollars, and the hardware bottleneck is incredibly real. This is where decentralized crypto networks come in. They allow people and data centers all over the world to pool their idle computing power and rent it out to AI developers. But here is the secret that most influencers will not tell you. Even if those specific decentralized AI token projects ultimately fail, the base layer blockchains that are used to settle their transactions still win. The blockchain infrastructure itself becomes the ledger for a new global server room. And that brings us to problem number three, which is easily the most important one: the agent economy. We're rapidly moving past the era of AI just being a chatbot that answers your questions. We're entering the era of AI agents. These are independent software programs that can act autonomously. They can optimize supply chains, manage investment portfolios, or hire human freelancers to complete microtasks on your behalf. But there is a glaring issue. An autonomous AI agent cannot walk into a local bank branch and open a checking account. It cannot use traditional payment processors because it does not have a legal identity. It cannot hold a passport. But it can hold a private key. An AI agent does not need a passport if it has a crypto wallet. It can receive funds, pay for its own server costs, and settle transactions instantly across borders using programmable digital dollars. This is the exact moment where crypto stops being a speculative casino and becomes strictly functional infrastructure. It becomes the native financial rail for the machine economy. So, if we are betting on this machine economy, what do we actually buy? I am not going to list off 20 microcap AI tokens that will probably be dead in a year. Instead, let us look at the base layers powering this entire revolution. First, Bitcoin, the monetary layer. Let us be clear, Bitcoin is not an AI coin. It is the reserve asset of the digital world. If artificial intelligence continues to drastically expand global GDP and hyper-automate labor, Bitcoin serves as the global liquidity anchor and digital collateral. It benefits passively from the massive capital expansion that AI creates. Next, we have Ethereum, the settlement layer. If AI agents are going to interact, they need smart contracts, escrow logic, and autonomous settlement. More importantly, Ethereum is the hub for stablecoin issuance. If machines are going to pay each other, they're going to do it on the Ethereum network. Finally, Solana, the high-speed execution layer. If thousands of AI agents are negotiating, trading, and transacting back and forth every single second, network speed is the ultimate bottleneck. Solana is actively competing to be that machine speed settlement infrastructure, offering high throughput and fraction of a cent fees. But here is the absolute most critical part of the artificial intelligence and crypto thesis. This is the part that 90% of crypto videos completely ignore simply because it is not as flashy as a new altcoin. Artificial intelligence does not want volatility. If an AI agent is trying to pay for an API call, rent server space, or hire a human freelancer to verify a piece of data, it does not want to use a native crypto token that might drop 20% in value while the transaction is processing. It wants a perfectly stable unit of account. It wants low fees, and it needs instant programmable settlement. Enter stablecoins. Specifically, major players like Tether and USD Coin. These are programmable digital dollars. They are not a niche experiment anymore. They are already processing trillions of dollars in volume annually. They settle 24/7, globally, without borders, and without asking for permission from a centralized bank or waiting for business hours to clear a wire transfer. Think about the future of global labor and autonomous commerce. When we have AI to human payments, AI to AI transactions, and fully automated machine microeconomies, they are going to run natively on stablecoins. If an AI system needs to procure supplies or negotiate a digital contract, it can do so entirely on its own by operating within a defined stablecoin allocation governed by smart contract limits. This entire new digital economy, where machines act as independent financial actors, runs on programmable fiat money. It does not run on highly volatile, speculative meme tokens. So why do so many artificial intelligence tokens crash and burn? It comes down to basic math and token economics. Here is the success formula. If network usage grows and the token supply is strictly controlled, the price appreciates. On the flip side, here is the failure formula. If a token's supply inflates rapidly and network usage stagnates, the price collapses. Most specific AI altcoins fail because they fall right into that second category. They have extremely high inflation schedules. Venture capitalists and early insiders unlock massive bags of tokens after a few months, flooding the market and creating immense selling pressure. And worst of all, there is zero real-world demand from actual users or autonomous agents to absorb that newly unlocked supply. This is exactly why the base layers we talked about earlier, like Bitcoin, Ethereum, and Solana, survive cycle after cycle. They are the inescapable infrastructure that the rest of the market relies on to function. When you buy into the base layer, you are not betting on a single experimental application, you are betting on the highway itself. Now let us talk about the trap, because there is a very dark side to this narrative, and it is exactly how retail investors lose all their money. Risk number 1 is vaporware. A massive percentage of artificial intelligence coins on the market today are literally just standard smart contracts with the word AI slapped on them to catch the algorithm. They have no proprietary tech stack, they have zero revenue. Risk number 2 is the valuation disconnect. We are seeing crypto networks valued at billions of dollars with virtually zero cash flow. Meanwhile, traditional AI startups actually have real customers, real revenue, and, ironically, lower valuations. Make it make sense. And risk number 3, narrative cycles. Crypto pumps heavily on mainstream headlines. A big tech company announces an AI breakthrough, and crypto AI tokens pump 40%. 2 weeks later, the news fades, and the tokens violently retrace 80%. This is not a stock market. This is reflexive liquidity. You are not buying a company, you are buying a fleeting narrative. Which brings me to my final warning. Investing in this space is not conservative capital. Crypto can drop 50% in a few months, 80% in a bear market and stay suppressed for years. Extreme exponential upside is mathematically tied to extreme exponential downside. If you cannot stomach regulatory risk, exchange failures, smart contract bugs, and massive drawdowns, do not allocate meaningful capital here. Treat this strictly as high-risk asymmetric exposure. The final verdict? AI and crypto merging is not fiction. The infrastructure case is absolutely real. We have Bitcoin as collateral, Ethereum as programmable settlement, Solana as high-speed execution, and stablecoins as machine money. But the market remains hyper-speculative. It is 90% noise and 10% structural transformation. Your job as an investor is not to buy the loudest ticker on social media. Your job is to know exactly which layer of the infrastructure you are actually betting on. If this video helped you understand the reality of the AI supercycle, hit the like button so the algorithm knows to show you more infrastructure and less hype. Subscribe to the channel, and I will see you in the next deep dive.